Mr. Bettaieb, this year the markets have been quite positive for investors. Did that come as a surprise for you after the worsening situation in 2018?
No, not really. I think the markets did well since the beginning of the year because basically the Fed has made a pivot. They have changed their stance. Unfortunately, the Fed had tightened too much last year. And on top of that, they were reducing their balance sheet. So this had compounded difficulties at the end of the day. We could see that last year following a very simple measure, M2 year-on-year growth in the US. Basically, that's a measure of US dollar liquidity a little bit in the world. And as the Fed was tightening quite a lot, the year-on-year growth rate really had collapsed from 9% to almost under 4%. So there was not enough US dollar liquidity in the world and in the US. So that created problems for EM at the beginning, as you recall last year. Then this shifted onto the equity markets. And when a chain reaction starts like that, it does not stop. So we had a very difficult quarter last year. Thankfully, at the beginning of January, the Fed has changed its stance. They said they would be patient and basically pause. And since the beginning of the year, now we see that they could also cut, and I think they will cut 50 basis points in July. So the market should continue to have this good feel factor, and hopefully this continues as well.
So your expectations are that the markets will stay favorable for investors?
Yes, absolutely, especially if the Fed cuts. I think we expect them to cut. My personal view is that they'll do 50 basis points and then stop and verify. That would be very positive for riskier markets. And when this happens, usually equity markets continue to do well. And I would not be surprised that the equity markets, even in Europe, have a good potential still, and upside 10-15%. I would not be surprised at all.
Now, there is some talk in the market that the Fed might cut also because there is a recession in sight. Do you see any risks like that?
I think people tend to associate low yields with very bad news, which should not be the case anymore, because really the world today is different. The financial structure is different. You have more divide between the haves and have-nots. So really one way to help the people who are not exposed to financial assets is basically to cut rates. I mean, one easy pass-through in the US is that when you cut rates, the mortgage rates come down. So that helps normal people which basically would not own financial assets. So I think that's positive. The central banks are also experimenting things. The world is different today. They can get inflation up. They can get inflation up because of digitalization. That's a new phenomenon since the last 7 to 10 years. So that has an impact. And really, the central banks are doing what they can on their own. They're doing the heavy lifting. They're not helped at all by the politicians, because we still had quite a lot of austerity measures in politics, especially throughout Europe. So in the end, they're doing what they can to try to sustain the cycle. And by cutting rates, I think the Fed basically will prolong the cycle, will improve the circulation of US dollar liquidity in the world. So that should be positive. And I'm not really worried, by the fact that we should see a recession because the yield curve is inverting or what may have you. I think the world is different today, and they're experimenting new things, as I said. So, it's not really indicative that things are going to turn bad, especially that the consumer, both in the US and Europe, is doing relatively well. So the lower the rates for them, the better, and it gives an incentive for people to consume. So we're quite relaxed that we should not see a recession in 2020.
Still, if the US Fed is going to ease, along with the ECB, which has shown signs that it will do so, what does it mean for the credit markets, which is I
think for the credit market, it's positive. Again, we are in a regime which has changed, from last year. We are in easy mode, from a central bank perspective. This means excess liquidity. Excess liquidity also comes from the fact that we see a lot of negative yields in the European area because there is this expectation that we have negative rates that could go a little bit more negative. So at the end of the day, if you take Europe's example, we have 4 trillion of European government bonds which are negative yielding. So people really don't want to wish to hold these. So for the credit market, it's positive because we still have a pickup. The spread pickup is still there. The spread basically represents the credit premium for a company. It's still there, so it represents a better value than government bonds. So in an environment where we still have, not great growth, but some growth, and the fact that there is a lot of negative yielding securities, it's positive for credit because people would tend to basically shift towards corporate bonds.
Mr. Bettaieb, thank you very much.
Thank you.